Here's what most income investors don't realize. Putting $250,000 into something like SCHD or JEPI is still going to leave you short of a comfortable retirement, even after years of saving. But what if you could safely turn that same investment into $40,000 or more a year using a simple approach with just 3 ETFs plus covered calls? Well, in this video, I'm going to show you exactly how to do that, the 3 specific ETFs to use, and how to actually do this strategy without taking on an excessive amount of risk.
Unless you've been living under a rock, you'll understand the past couple of years have been fantastic for capital appreciation. SPY is up almost 50%. Things like the NASDAQ are up 78%. Individual stocks, I've just got some names here. Nvidia, Meta, Palantir have had phenomenal runs. And even things like Bitcoin and gold have been doing really, really well over the past couple of years since the market really bottomed at the end of 2022. However, if you're an income-focused investor, it hasn't been such a good time. I-bonds, remember those? 9%, risk-free. Yeah, you're not getting that anymore. It's down to 3.11% now. Money markets and T-bills, which once again were a risk-free 5% plus, you're not getting that anymore. You're looking more about 4.5, 4.6 maybe. High-yield bonds, a way that a lot of people like to generate income, it ain't happening. HYG, which is the largest high-yield bond ETF, including dividend distributions, you're getting 2.5% before fees cumulatively over the past 2 years. And then individual stocks, and a lot of these names were long-time solid, steady dividend payers, have let you down as well. 3M cut dividends for the first time in 64 years. Walgreens Boots cut dividends by 47%. And then Celanese cut dividends by 95%. And the fact is, a lot of people are struggling financially. The cost of living has gone up anywhere between 25 and 40% over the past couple of years, depending on the source. 44% of retirees are now considering a return to work because of this. People now believe they need 1.46 million to retire, which was up from 1.24 million last year. So the expectation for how much money you need to live off your portfolio has gone up by $200,000 in a year. And a low yield environment, which is what we're really coming into now with rates declining. I love this quote from Howard Marks where he says, "Before you had income and safety, in a low interest rate world, you have income or safety." And so what that does is it forces people to look further afield for higher paydays. And this, combined with a rise in stock screeners, software where you can just type in, "I want to see all stocks with a 10% dividend yield," it's led us down a very, very dangerous path. Because you can't just buy and hold the SPY for income. It's not going to happen. Dividends are at a 24-year low. The latest distribution, the yield was 1.23%, lowest it's been since the year 2000 and the dot-com boom. People are naturally looking further afield, and these sort of dividend or income-focused ETFs have become massively popular over the last couple of years. You've got your VIGs, SCHDs, which, haven't been bad. You get a pretty decent return, but once again, if it's income you're after, you're not getting much. VIG pays less than 2% now. And when you consider that's a dividend aristocrat ETF, dividend aristocrats, steady dividend paying companies, you're getting less than a 2% yield. SCHD is slightly better, but you're still only getting 3.37%. And then you've got some of these newer products, these income-focused ones, which use options themselves, like JEPI. QYLD is another one that was very popular a couple of years ago. They have higher overall yields, but their overall performance is worse if you factor capital appreciation into that. And you kind of have to, because you can't look at them separately. the fact of the matter is this: if you're near a retirement age, income is what you want, not capital appreciation. Your ultimate goal here is to live off the income from your investments without having to touch your principal. This is why I've never liked the whole FIRE number methodology, because it's inherently flawed. You spend 10, 15, 20 years saving up all this cash, exercising one muscle, seeing this number in your account grow, and then overnight you're supposed to switch and start withdrawing from that, and you see that number go down. That's really difficult for a lot of people to do, because you spent 20 years doing one thing, now you're forced to do the opposite. It's much harder in practice than it looks on a spreadsheet. And the fact of the matter is, if it's an income-only equation, $500,000 in SCHD, you're getting $16,000 a year, just over $1,000 a month, and that's before fees. JEPI is a little bit better, $35,000 a year, once again before fees, so your actual amount is going to be lower. And $500,000 portfolio to make $35,000 a year is simply not good enough, and that's not even factoring in potential capital losses. So I have what I believe is a better solution to this. So I'm going to use the exact same amount, $500,000, and I'm going to create a 3 ETF portfolio. The 3 ETFs I'm going to use here are GLD, which is a spot gold ETF, IWM, which tracks the Russell 2000 index, and QQQ, which is the NASDAQ 100. So I'm going to have 700 shares of GLD, 700 shares of IWM, and 300 shares of QQQ, which gives me about an equal weighting. So totaled up, at today's prices pre-market, that's $480,679. And I think this is a fairly decent 3 ETF portfolio. It covers a lot of bases. You've got gold, which acts as like a defensive hedge, IWM, which is 2,000 small cap US companies for a bit of diversification, and then also QQQ, obviously larger tech focused companies. That's more so for the capital upside. So I've got upside, I've got diversification, and I've got a bit of defensive hedging in there as well. And I can already hear the keyboards being smashed as people are watching this. I can already hear it because people are saying, "What are you doing? Those don't pay any dividends. I thought this was an income video. Why are you choosing the NASDAQ for income?" And just pump the brakes a second. Allow me to finish, please. I never said I was just going to hold them. So I want to introduce our friend, the covered call. The covered call, if you're not familiar with what they are, it's where you just sell call options on these particular ETFs to generate extra income. I like to call it a synthetic dividend because you are generating income on demand. Much like a dividend, it is income, not capital appreciation. The other reason I like covered calls, it's completely possible in retirement accounts. So if you've got a solo 401k, or if you've got a Roth IRA or another sort of tax advantaged account, then this is a strategy that's completely applicable within those accounts. So for example, GLD, the gold ETF, today pre-market it's trading at $237 a share. So I can sell a covered call option expiring in 28 days time at a strike price. Come on. Strike price. I'm not perfect. Strike price of $243. Now I get paid $2.13 per share for doing this, because when you sell an option, you get paid to do so. One options contract represents 100 shares. So if you're wondering why I chose round numbers for those ETFs earlier, this is why. One options contract is 100 shares, so I would get paid $213 per contract. Now, I say expiring in 28 days time because all options have expiry dates. So what happens in 28 days time? If GLD is below 237, then the option expires worthless. It becomes worth zero. Because we already sold it, if you're the option seller, you got paid. So it doesn't matter. You get to keep the money. And best part is you can just do it again and again and again and again. If GLD is above 237, then you will sell the shares at a $243 per share price. But because you already got paid $2.13, you get to keep the money no matter what. So in essence, your effective sale price is $245.13 per share, which is a nice little profit of 28 days. So people always ask me when I talk about this, well, what are the downsides? So there are no additional downsides when you sell covered calls because you already own the shares. It's not like a put option where, in theory, you sell a put option, the stock absolutely plummets, and then you're forced to own shares at a much higher price than what they're worth. But with a covered call, these are much simpler because you already own the shares. And so your downside risk, the only sort of risk in here is opportunity cost. And if you're not using super volatile stocks or ETFs, which you shouldn't be if you're an income-focused investor, then there's not much opportunity cost to actually worry about. So let's actually look through the entire portfolio and see what this would actually do income-wise for your portfolio. So we've got GLD here, and these are actual numbers I grabbed pre-market. So we've got this trade, which once again expires 28 days from now on December 13th. So it's a 31 delta, which is a relatively conservative trade. I'm not going balls to the wall here in terms of taking on a bunch of risk. This is a no additional downside trade. So I'm going to get paid $213. I've got the mid price here between the bid and the ask per 100 shares. Now remember, I own 700 shares in the portfolio. So that's $1,491 in income. If we're talking ROI, that's a 28-day ROI of 0.89%. Annualize that out, that's 11.71%. Much better than 3% already. Let's look at the other two. So let's look at IWM. Once again, very, very similar trade, 31 delta expiring in 28 days. This time I get paid $269 per 100 shares. So the overall is a little bit higher. It's a 1.16% ROI. That's 1,883 for the 700 shares that I own. On an annual basis, that's a 15.2% return. And once again, this is income, not unrealized capital gains. QQQ, I'm only selling 3 contracts because I own 300 shares instead of 700, but I'm getting more per contract. So I'm getting about $530 per contract here. This one is actually not a 31 delta. It's a 30 delta trade, so even more conservative. $530 per 100 shares. That's $1,590 for my 300 shares. 28-day ROI of 1.04%. Annual ROI of 13.6%. Now let's compare this to SCHD and JEPI. So I've got 3 sample portfolios here, 500k in JEPI only, 500k equal weighted between SCHD and JEPI, and then my smaller 480k portfolio, the 3-ETFs using covered calls. Now, as you can see, you do not have to be a wizard to work out which one offers the best returns. JEPI, paraded as this fantastic high yield ETF, this portfolio almost doubles it. And I would also want to add here, I think this portfolio has much higher capital upside than only having JEPI. So if we're talking absolute terms, in terms of yield, this is a 13.28% annual yield with a 480k portfolio that's over $60,000 a year, almost double JEPI only, and more than double an equal weight SCHD and JEPI. And you're not going to get anywhere near this holding T-bills, money market funds, but I also understand there's a risk-free element to holding those two. However, if it's, I want to live off my portfolio income this right here is a far superior choice. And when I come to this point in the video, people usually say, but what if I can't afford 100 shares of those? $500,000 is a lot of money. I don't have that kind of money. Well, there's always an alternative. So for example, if you can't afford GLD, which is $230 a share, so you need $23,000 for 100 shares, you can use something like GDX. Similar instruments, I mean, it's gold mining stocks as opposed to gold itself, but it's going to track very similarly. That's just $35 a share. So you only need $3,500 for 100 shares. If you can't afford IWM, you could use something like XLP, which is the consumer sector ETF. That's $82 a share. Probably going to track similar. At least it's going to be roughly the same. And QQQ, you could use a tech focus ETF like ARK-K for just $53 a share. Once again, the performance is not going to be identical, but it's going to be similar. They hold similar types of stocks. In terms of the overall sector volatility, it's going to be very similar. So you're going to get similar performance and volatility with a much smaller portfolio. And plus, if you don't want to use ETFs, you can always use individual shares. And personally, that's where I tend to gravitate more towards these days, just because you do get better performance. And plus, I get more control over my portfolio overall in terms of what I own and what I don't. So if you enjoyed this video, I have written a book on this. It's available on Amazon. It's got 899 reviews as of today. So hopefully by the time this video comes out, I'll have 900. Tons of people like it. It's a very, very simple way to make extra income on your portfolio using covered calls. You can read it from start to finish in a couple of hours. And yeah, if you're looking for extra income from your portfolio, this is probably where you should start. I also have some stuff on the wheel, which is a slightly more advanced version of this strategy, but one that can produce much higher returns. If you want to know more about that, I've got some stuff in the description as well. But if you enjoyed this video, please consider subscribing, and I will see you in the next one.